You know, I've always said that a trader's greatest enemy isn't the market. It isn't even the stock itself, or the tape, or the news that rattles the weak hands out of their position. No, the enemy sits right there in the trader's own chair, wearing his own hat. It's the fellow who looks back at him from the glass every morning. That's the hardest opponent you'll ever fight. And when you start talking about adding to a position, about pyramiding, you're really talking about discipline, patience, and knowing the difference between a favorable trend and your own stubborn hopes. Now, before I lay it out, let me remind you today's talk builds on what we discussed in the previous video on expert-level trading. That foundation matters because adding to a position isn't for the beginner or for the fellow who can't yet tell the difference between a healthy pullback and the start of a collapse. You need that grounding first. Otherwise, pyramiding will only ruin you quicker. So let's get right to it. I'll talk to you straight. No fancy tricks, no magic words, just the 4-step pyramiding rule. The only way I ever found to add to a position safely and profitably without turning a good trade into a reckless gamble. You want to know when to press your bet? Then listen carefully, because the market doesn't hand out many second chances. The first thing a man must realize is this: you never average down. Never. That's the surest road to the poorhouse. If you buy a stock at 50 and it drops to 45, and you start thinking you'll bring down your cost by adding, you're not trading, you're speculating against the trend, and you'll soon be broke. A stock isn't cheap just because it's fallen. It's cheap only when it starts going up. Do you follow me? Think about that. The right time to add to a position is only when you've got proof written on the tape that your first decision was correct. You don't add because you hope. You add because the stock itself tells you it's in motion, in your direction. That's the difference between the sucker and the professional. The sucker adds when he's losing. The professional adds when he's winning. Which one do you want to be? Now, the rule I always followed was simple, though not easy. You build a pyramid, never a flat block. You buy your first lot, maybe 100 shares, maybe 1,000, depending on your stake and the price of the stock. That's your foundation. Then, if the market proves you right, you add but less than before. Smaller, always smaller. Each addition should be lighter than the last. Why? Because you never want to get so top-heavy that one turn of the market knocks down the whole structure. Think of it like climbing a ladder. Would you put your full weight on the top rung while the bottom wobbled? No. You climb carefully, testing each step before you trust it with more of yourself. That's how pyramiding works. You put more on when you've got solid ground, and you put less on as you rise. Let me walk you through it step by step so you can see it clearly. The first step is your initial position. This must always be the largest of your buys. It's your stake in the idea, your vote of confidence in the trend you've spotted. You've studied the chart. You've seen the line of least resistance. The stock breaks through resistance, or it's just clearing out of a long base, or maybe the market itself has turned upward and your stock is leading the advance. That's when you put on your first lot. This is your foundation, your cornerstone. Now, when should you add? Not immediately, not recklessly. You wait. You let the market confirm your judgment. That's step 2. If the stock moves up 2 or 3 points above your first buy, and it does so on healthy activity, real demand showing itself, that's when you add. But this second lot must always be smaller than your first. If you bought 1,000 shares the first time, you buy 500 now. If you bought 100, you add 50. Always smaller. Why? Because the market has already rewarded you for being right, and now you're pressing the bet. But you don't want to get greedy. You want to build carefully, cautiously. Do you see how this forces you to only add when you're right, and never when you're wrong? The third step comes when the stock again confirms the move. Another 2 or 3 points higher, another show of strength. Then you add again, smaller still. If you bought 500 the second time, maybe 250 now. The point is the same, you're pyramiding upward, never flat, never doubling down. And the fourth step, the final addition, is only when the stock has clearly moved into full stride. Another 2 or 3 points above your last buy, more proof, more evidence. Then you put on your smallest lot of all, maybe 100 shares, maybe less, just enough to ride the move with full confidence. And that's it. 4 steps. The largest first, then each addition smaller, and only made when the market proves you right. That's the pyramiding rule. Simple, isn't it? But I tell you, few follow it, because most men can't resist the urge to get in big at the top, or to add when they're losing. That's the weakness of human nature. And the market always punishes weakness. Now let me ask you, how many times have you seen a man ruin a good position by getting greedy? He buys at the right time, makes a fine profit, then doubles up at the first sign of a pullback, thinking he'll squeeze out a few more points. Next thing you know, the stock reverses, and he's sitting on a loss where he once had a gain. He violated the rule and the market took back its gift. Haven't you seen that before? Discipline. That's what separates the professionals from the public. The professional doesn't care about excitement. He doesn't need to trade every day. He waits for his spots, makes his plays, and builds his pyramids only when the market justifies it. That's why he survives, while the crowd is always looking for the next get-rich-quick scheme. Let me remind you of something we spoke about in that previous session on expert-level trading. Remember how I said a trader must operate like a general, waiting for the moment when his troops can strike with maximum effect? Pyramiding is exactly that. You don't send in all your divisions at once. You test the line. You probe. Then you bring in reinforcements, smaller each time, as the battle swings in your favor. That's how you win campaigns, not just battles. And let me be clear, this method isn't about trying to squeeze every last dollar from a stock. It's about building wealth steadily, with the odds in your favor. You see, when you pyramid correctly, the market itself is paying you to take on more risk. Your earlier profits cushion the later bets. You're playing with the market's money, not your own. And that, my friends, is the safest risk you can take. But don't misunderstand me. Safe doesn't mean certain. The market can still turn. That's why your stops must be in place always. You must know the point at which you'll cut your losses, no matter what. Never argue with the tape. Never hope. Hope is a poor companion in the market. Have you ever known a man who made a fortune by hoping? I haven't. Now, let's talk a little about the mental side. Because pyramiding isn't just numbers and charts. It's about controlling yourself, your impulses, your emotions. You see a stock climbing and you're in it. You want to add big. You want to ride the wave. That's greed talking. And greed is the cousin of fear. Both will bankrupt you. The pyramiding rule forces you to act with restraint. It forces you to think in terms of structure, not impulse. You're not chasing the market. You're building carefully, like a mason laying stones. Each layer must rest securely on the last. That's how you build wealth. That's how you build a career. Some men laugh at such caution. They say, why not bet it all when you know you're right? Well, I'll tell you why. Because you don't know. You never know. The market knows, the tape knows, the crowd knows. But you're just guessing. Your only edge is to wait for confirmation and then act. Always smaller, always safer, always upward. That's the pyramiding law. And if you break it, if you start adding more on the way down, or you add bigger as you go up, you're courting disaster. It may not strike the first time, or the second, but it will strike. And when it does, you'll give back not just your profits, but your principal too. Haven't you known men like that? Rich today, busted tomorrow. That's what happens when you forget the pyramid and start playing the pyramid in reverse. So remember this: a successful trader is like a builder. He lays the foundation wide, strong and firm. Then he builds upward, narrower each step, until he reaches the top. A foolish trader builds upside down, piling more and more weight on a weaker base, until the whole thing tumbles. Which kind of builder are you going to be? Now, let me circle back for a moment, because there's a point here too many overlook. The whole pyramiding principle is tied to the broader mindset of trading, of thinking in terms of probabilities, not certainties. The previous discussion on expert-level trading wasn't just about tactics, It was about cultivating this mindset. Pyramiding is a natural extension of it. You're never betting on one move, one trade, one tick. You're aligning yourself with the trend, reinforcing your position as the evidence mounts. That's how the professional thinks. That's how you must think if you want to last. I'll tell you something else. When you pyramid properly, you're training yourself to be patient. Patience is the trader's most valuable weapon. The crowd can't sit still. They must always be in the market, always chasing, always fidgeting. But the professional, he waits. He waits for the right stock at the right time, in the right trend. Then he builds his position carefully, layer by layer. That's why he profits where the crowd loses. Do you see the difference? One man is gambling, the other is operating a business. Which one do you want to be? When I tell you that pyramiding must always build upward, like a structure, never flat and never inverted, I am not giving you some fanciful metaphor. I am describing the essence of sound trading practice, and it is no different from the way a builder or architect would approach his craft. A strong building starts with a broad base and grows narrower as it rises. That tapering, that discipline in proportions, is what keeps it standing when the winds blow and the ground shakes. A trader who ignores this principle is building an upside-down tower, wide at the top and narrow at the bottom, destined to collapse under its own weight at the first gust from the market. Think for a moment about the very idea of pyramiding. Why does a trader add to a position in the first place? It is not because he wants to gamble bigger. It is because he recognizes strength. He sees the stock behaving as he expected, the market confirming his judgment, and he wants to press his advantage. There is nothing wrong with that. In fact, it is the mark of confidence built on evidence. But the way you add makes all the difference between compounding profits and compounding mistakes. If you add in equal blocks, you are building a flat structure, a wall with no taper, and one push can knock the whole thing over. If you add in increasing blocks, larger than your first, you are stacking the pyramid upside down, with the widest layers at the top. That is an invitation for disaster. Let me make it plainer with numbers. Suppose you buy 1,000 shares at $50. The stock moves to 53, and you decide to add. If you add another 1,000 shares, your pyramid is flat. You now hold 2,000 shares with the same weight on each layer. If the stock dips back to 51, a perfectly normal retracement, that equal weight can wipe out your cushion and turn the position against you. Now suppose instead that you had added only 500 shares. The stock slips a couple of points, but your original 1,000 is still in profit, and the smaller second layer is not enough to topple the whole structure. You see the difference? The taper protects you. It preserves the integrity of the position, even when the market breathes in and out. Now imagine the trader who does the opposite. He adds more as the stock rises. He buys 1,000 shares at 50, 2,000 more at 53, 3,000 more at 56. His pyramid is upside down, wider at the top than at the base. The stock wobbles, pulls back 3 or 4 points, and the man is finished. The weight of his later additions crushes the position, and what began as a sound entry is ruined by his impatience and greed. Do you think the market cares about his cleverness? It punishes him for violating the natural order of things. The tapering method, the true pyramid, is not about being timid. It is about being strategic. By adding smaller amounts as the stock advances, you are using the market's own movement to finance your risk. Your first layer is your boldest commitment, placed when the breakout begins, when the odds are strongest in your favor. Each layer above is confirmation, but it is also higher in price and closer to potential exhaustion. You respect that by reducing size. You acknowledge that the higher you go, the less room you have to be wrong. Isn't that the sensible way to trade? The crowd, of course, cannot think in these terms. They want the excitement of doubling and tripling their stake when the stock is flying. They forget that no stock rises in a straight line, and that even the strongest trends contain pullbacks. They are like builders piling bricks on the top floors while neglecting the foundation. And when the first crack shows, they scramble, blaming the market, the news, or the stock itself. But the truth is simple: they built their position upside down. This principle also ties directly to the psychology of trading. By building upward with smaller layers, you give yourself room to breathe. You are not constantly on edge, fearing that one bad tick will wipe you out. You know your structure is sound. You know that if the market turns suddenly, your heaviest commitment was at the lowest price, and each successive layer was smaller. That confidence, that steadiness of mind, allows you to follow the trend without panic, and isn't trading, at its core, a battle for your own emotions. Consider also what happens when the stock continues higher. Each new layer, though smaller, is built on top of profits from the lower ones. You are not exposing yourself recklessly, you are compounding gains. The market is paying you to take more risk, and you are doing so in the safest manner possible. That is the beauty of the upward pyramid. It lets you press your advantage while respecting the fact that no trend lasts forever. I'll give you an example from my own experience. Years ago, I bought into a stock breaking out of a long consolidation. I put on a heavy initial position because the pattern was clear and the market was strong. The stock rose 2 points, and I added half as much. It rose another 2 points, and I added again half of the half. 4 layers in total, each smaller than the last. By the time the stock had advanced 10 points, I held a sizable position, but it was built on profits. When the inevitable pullback came, it shook out the latecomers, but my pyramid held firm. My base was strong enough that even with the retracement, I remained in profit. That is what I mean by building upward, never flat and never inverted. Now picture if I had doubled my size at the second buy. The pullback would have wiped out the gain from my base and left me holding a burden at the top. That is the danger most traders do not see until it is too late. They think more is always better. They think conviction is shown by size alone. But the market does not reward bravado. It rewards structure, discipline, and proportion. You may ask yourself why so many traders make this mistake. The answer is simple: impatience and greed. They cannot stand the thought of missing out on more profits, so they throw discipline aside and pile in. They forget that the game is not about one trade, one run, one streak. It is about survival, about building wealth over years, about staying in the market long enough to let compounding work in your favor. The upward pyramid is the tool that allows this survival. It lets you scale in without toppling your structure. And think about the broader principle. In any endeavor where risk is involved, the wise man builds upward with diminishing commitments. The general sends his strongest forces first, tests the line, then reinforces cautiously. The businessman invests most heavily at the start, then expands with smaller ventures as profits allow. The farmer plants his largest crop in the fertile soil and smaller trials in less certain fields. The trader is no different. He must respect the law of diminishing certainty as the move extends. So when I say pyramiding must always build upward, never flat and never inverted, I am giving you the law of survival in this business. It is not a matter of opinion. It is the difference between being the man who lasts and the man who blows up. Every time you add, ask yourself, am I widening the base, or am I stacking weight on the tip? If it is the latter, stop at once. The market will not forgive you. It will take back everything and more. But if you build upward, narrower each step, you give yourself the only kind of safety the market ever grants, the safety of sound structure backed by discipline. Discipline in pyramiding prevents greed from taking control. That is not just a phrase to repeat. It is a truth that makes the difference between a trader who lasts and one who burns out quickly. You see, the market has a way of tempting men to overreach themselves. A few points in their favor, a few dollars of profit on the table, and suddenly they forget the plan they swore to follow. They begin to believe they can't lose, that the market owes them more because they caught the move early. That's when greed sneaks in, whispering that they should double up, pile in, or throw away the careful proportions of the pyramid. And the moment they do, they're no longer trading, they're gambling. Discipline is the steel framework behind the pyramid. Without it, you might as well build with sand. Every layer you add must be thought out, timed, and sized with precision. When you lack discipline, you don't wait for confirmation from the tape, You don't respect the rule of smaller additions. You don't keep your stops in place. You let greed take the wheel, and greed only knows one direction: more, more, more. But the market doesn't care about your hunger. It punishes excess every time. Have you ever seen a man make a fortune and lose it just as quickly because he couldn't stop adding bigger and bigger? That's greed masquerading as confidence, and it's fatal. The purpose of pyramiding is to compound your advantage when you're right. Discipline ensures that compounding stays under control. You buy your first position with the greatest conviction. Then, as the stock proves you correct, you add less each time. Discipline reminds you that the higher the price climbs, the closer you are to the turn. It forces you to respect risk, even in the face of success. Greed, on the other hand, tells you success means the rules no longer apply. Greed whispers that because the stock has risen 5 points, it will surely rise another 5. Greed tempts you to add more at 60 than you did at 50, which is the exact opposite of pyramiding done properly. Now ask yourself this: when have you ever regretted following discipline? Never, but you can recall plenty of times when giving in to greed cost you dearly. The truth is that most traders don't lose because they lack knowledge. They lose because they lack control. They can recite the rules. They can draw the patterns on the chart. They can even explain pyramiding to someone else. But in the heat of the moment, when their stock is soaring, they forget discipline and let greed run the show. And that is why the market continues to collect tuition from the crowd. Discipline in pyramiding works like a brake system on a fast car. The car may be capable of great speed, but without brakes it is nothing more than a death trap. Your pyramid may be capable of capturing large profits, but without discipline, it becomes unstable and collapses. Every time you add smaller, every time you wait for confirmation, every time you resist the urge to go bigger, you're tapping the brakes, keeping your speed under control. And that control is what allows you to finish the race instead of crashing on the first corner. Another way discipline defeats greed is by keeping you focused on process rather than outcome. Greed is obsessed with outcome: how much money you can make today, how quickly you can double your account, how big the win will look on paper. Discipline is focused on the process. Was the breakout real? Did the volume confirm? Has the stock moved enough to justify another layer? Is the size of the new buy smaller than the last? When your mind is fixed on the process, the outcome takes care of itself. But when your mind is fixed on the outcome, you skip steps, you ignore warnings, and you build the pyramid upside down. Which mindset do you think survives in the market? Let me tell you something from experience. When you are on the right side of a big trend, it feels like you've found a gold mine. Every day the stock ticks higher, and every day your account swells. That's when discipline is hardest to maintain, because you start to believe you're invincible. You start to believe you've mastered the market. But that is the very moment when greed waits to ambush you. You start thinking, why not add double here? Why not go all in now that I'm so far ahead? And if you listen to that voice, the market will teach you humility in the most expensive way possible. Discipline is the only shield you have against that temptation. Notice also how discipline in pyramiding shapes your psychology when the market pulls back. If you've added carefully, each layer smaller, you can watch a normal retracement without panic. You know your base position is still strong. You know your risk is controlled. But if greed has led you to add recklessly at the top, the smallest pullback feels like disaster. You panic, you sell at the worst time, or you hold in stubborn denial until the loss becomes unbearable. Discipline not only protects your money, it protects your peace of mind. Discipline also means sticking to the rule that you never add on weakness. Greed tempts you to buy the dip because you don't want to miss the next leg up. But pyramiding is not about buying dips, it is about pressing strength. You add only when the stock proves itself by moving higher. That's discipline. Greed tells you to ignore the tape and guess at reversals. And most of the time, those guesses turn into dead money or worse, outright losses. Think about how discipline interacts with time. The undisciplined trader is impatient. He wants action now, more size now, bigger profits now. The disciplined trader understands that building a pyramid is slow, deliberate work. It might take days, weeks, even months to add all 4 layers. Each step demands patience. Greed cannot wait that long, and so it sabotages itself. But discipline waits, and waiting is often the difference between catching the full swing of a trend and being shaken out in the noise. Even wealth building itself is a test of discipline versus greed. The disciplined trader thinks in terms of steady accumulation, preserving capital first, then compounding it carefully through methods like pyramiding. Greed thinks in terms of windfalls, jackpots, sudden fortune. That is why the crowd is always looking for tips, rumors, shortcuts. They don't want the discipline of a method, they want the excitement of a gamble. But trading is not gambling. It is a business, and no business survives without discipline. Discipline also teaches you humility. It reminds you that no matter how much the market has given you, it can take it back in a heartbeat. It reminds you that you are not smarter than the tape, not stronger than the trend, not above the rules. Greed, on the other hand, feeds arrogance. It convinces you that this time is different, that you know better, that the rules don't apply. And arrogance is always followed by ruin. Have you ever noticed that the biggest blow-ups in Wall Street history were never caused by ignorance, but by arrogance? Men who thought they were too smart to fail, too powerful to lose, too special to need discipline. And the market humbled them all. When you follow discipline in pyramiding, you are acknowledging the limits of your own foresight. You are admitting that you don't know how far the stock will run, so you build carefully. You are admitting that each higher price carries more risk, so you size smaller. You are admitting that trends can reverse, so you protect yourself. That humility is your strength, because it keeps you aligned with reality. Greed blinds you to reality. It convinces you that the trend will last forever, that you can keep adding more, that your fortune is secure. But there is no such thing as security in speculation, only discipline gives you stability. So when I tell you discipline in pyramiding prevents greed from taking control, understand that I am not just talking about one technique. I am talking about the entire mindset of professional trading. Discipline is the line that separates building a true pyramid from building a trap for yourself. Discipline is the voice that says, add smaller, when greed is shouting, add bigger! Discipline is the reminder that trading is not about excitement, but about survival. And every time you choose discipline over greed, you give yourself another chance to stay in the game, another chance to build wealth steadily, another chance to let the market work for you instead of against you. Success in trading comes from patience, waiting for the right setups before pressing the bet. This is one of those truths every trader nods to, yet only a few actually live by. The market is always moving, always flashing prices, always tempting you with action. But most of that movement is noise. The skill lies in separating the noise from the signal, and that separation can only be made by patience. You cannot rush the tape. You cannot demand the market give you opportunities on your schedule. The market has its own clock, and if you are wise, you learn to wait until the hour strikes in your favor. Patience is the rarest quality on Wall Street. Everybody wants action, everybody wants excitement, everybody wants to feel alive in the market. They forget this is a business, not a circus. The man who trades because he is bored, or because he cannot sit still, is doomed from the start. He is chasing every wiggle, every rumor, every little uptick, as though fortune hides in the daily chatter, but it doesn't. Fortune hides in the major swings, the clear setups, the real trends that only show themselves when time has burned off the uncertainty, and to catch those you must wait. Think about pyramiding itself. The whole method depends on patience. You put on your first position, then you wait. You do not add immediately. You do not press just because you feel good about it. You wait for the stock to prove you right. Then you add, smaller, and you wait again. The discipline of smaller layers is tied directly to patience, because you are willing to let the market show its hand at each step. If you lack patience, you break the structure. You add too soon, too much, and the whole pyramid collapses before it is even built. Now, ask yourself honestly, how many times have you cut a winning trade short because you couldn't wait? How many times have you sold at the first dip, only to watch the stock march higher for weeks afterward? That is impatience robbing you of profit. The professional trader doesn't let small pullbacks shake him, because he knows the trend takes time to unfold. He knows that real moves don't happen in hours, but in days and weeks. Patience is what allows him to ride them out. The crowd, on the other hand, is always fidgeting, always nervous, always jumping at shadows. They cannot sit still, and so they sell too soon or buy too soon, and the market keeps collecting their chips. Patience is also what keeps you out of bad trades in the first place. The undisciplined trader wants to be in the market all the time. He cannot stand to see a stock move without him, so he jumps in without a setup. He buys because the tape is active, or because a neighbor mentioned it, or because he feels like he's missing out. That's not trading, that's desperation. The patient trader knows that missing one opportunity is nothing compared to losing money on a bad one. He waits for the chart to confirm, for the resistance to break, for the volume to appear. He waits for the signal, not the feeling. And when it comes, he strikes hard, with conviction, because his patience has given him clarity. You know, in this game of speculation, the only real teacher is the market itself. The ticker doesn't care about your opinion, and it doesn't care about mine either. It'll hand out punishment without mercy and reward without warning. That's why the rules you set for yourself are the only armor you've got. In the previous video on the rule that prevents losses, I spoke about the importance of cutting your risks before they turn into ruin. Today, we'll go a step further and talk about protecting the profits you've already fought to win. And for that, there's a tool, plain and simple, that does the job better than most, an ATR stop-loss rule. Now let me ask you, what good is a profit if you let it slip away just because you were too stubborn to take it? Haven't you seen a man watch a winning trade turn into a loser because he thought he was smarter than the market? I've seen it and I've lived it. And every time it happens, the market stamps the lesson deeper into your mind. You don't own those profits until you learn how to guard them. The average true range ATR, as the chart men call it, is nothing fancy. It just measures volatility, the ups and downs, the swings and shudders of the market. And if you've been at this game long enough, you know that volatility is the very heartbeat of speculation. You can't predict the heartbeat, but you can measure its rhythm. That's where the ATR comes in. It tells you how much room the market usually takes to breathe. And if you know the market needs to breathe, why would you choke it with stops that are too tight? You give it enough room, but not so much that you risk your fortune. Think about this. If you're in a trade and you set a stop loss just one tick under the last swing, haven't you noticed how often the market will shake you out only to run right back in your direction? It's almost like the market hunts for your stop, and that's because you're placing it where every other greenhorn is placing his. But when you use an ATR stop, you're not guessing. You're letting volatility itself dictate the breathing room. Tell me, doesn't it make sense to let the market itself tell you where your protection should be? Isn't it wiser than clinging to your own opinion? When I was young in the bucket shops, I learned quickly that the market punishes impatience and arrogance. A stop that's too close is impatience. A stop that's too far is arrogance. The ATR stop balances those two sins. You take the average of the recent ranges, multiply it by a factor that suits your risk tolerance, and you set your stop that distance away. If the market wants to take you out after all that, then it's not your game to play anymore, and you step aside without regret. The thing most traders never understand is that profits must be defended just as fiercely as capital. Capital is your ammunition, yes. But profits, those are the results of battles won. If you don't lock them in with discipline, you're giving back territory you already conquered. That's foolishness. Do you go to war, win ground, and then hand it back because you didn't bother to fortify? Of course not. So why do it in trading? Now you might ask, but Jesse, how do I know how many ATRs to use? That, my friend, is where judgment comes in. Too small, and you'll suffocate your trade. Too large, and you'll be giving the market too much leash. For trending stocks, I'd rather give them more room, maybe 2 or 3 ATRs. For quicker plays, tighter swings, I'll narrow it down. The principle is the same, let volatility dictate, not your hope or fear. Do you see what this does to your mind as a trader? It removes the guesswork. Instead of staring at the screen, wondering whether to hold or fold, you have a rule, a formula, a mechanical out. That frees you to focus on the bigger picture. And in this game, clarity of mind is more valuable than any tip or rumor. Most traders lose because they don't understand themselves. They don't know how much pain they can handle, or how much profit they're willing to protect. They move their stops out of fear, or they cancel them out of greed. But when you tie your exit to ATR, you're surrendering that weakness. You're saying, I'll let the market's rhythm tell me where I'm wrong. That's discipline. That's strength, and discipline, more than brains, is what keeps a trader in the game. Haven't you seen a fool with discipline outlast a genius with none? The genius makes a killing one day, and then he's wiped out the next because he wouldn't cut a loss or protect a gain. The fool, steady as a mule, trudges along, never risking too much, never giving back too much. And before long, the fool is the one still standing. What you're learning here isn't just about where to place a stop. It's about building the habits of a professional. When you respect volatility, you respect the market. And when you respect the market, you respect your own capital. Do you see how that ties right back to the principle we spoke about in that last video, the rule that prevents losses? Back then, we focused on stopping ruin. Now, we're talking about stopping erosion. It's the same logic, just applied to profits instead of principle. But let me tell you something most traders never admit. The hardest thing in speculation isn't cutting a loss, it's cutting a winner short. Because greed whispers in your ear, hold on, it's going higher. And fear whispers, don't take it, you'll miss the big move. That's the devil on both shoulders. The ATR stop silences them both. It gives you an unemotional exit. When it triggers, you're out. No debate. No begging. No praying. Just action. Isn't that the kind of trader you want to be? The kind who acts on rules, not on emotions? Listen to me. The men who last in this business, the men who actually grow their stake year after year, are the ones who master 2 arts, the art of entering at the right moment and the art of exiting with precision. Most focus on the first and ignore the second. That's why they never build real wealth. A good entry without a disciplined exit is just half a trade. Half a trade is no trade at all. Now picture this, you buy a stock that's trending strong. You've got the wind at your back. You set an ATR stop 2 ranges below your entry. The stock moves in your favor, and what do? You trail the stop along, always keeping it that safe distance from the current price. You don't need to guess when the move is over. The market itself will tell you, because when volatility shakes too hard against you, your stop gets hit, and you're out with profits in hand. Do you see how beautiful that is? You're not trying to call tops. You're not trying to outsmart the crowd. You're simply following the move until the move says, enough. That's how money is made in speculation, not by being clever, but by being disciplined. Most amateurs dream of catching every last tick. They want the glory of the top and the bottom. But professionals know better. They're satisfied with the middle. The ATR stop locks you into the heart of the move and spits you out before the rot sets in. You don't need the extreme highs and lows. You need the fat part of the trend. And that, my friend, is where fortunes are built. But let me ask you, how many times have you given back a good portion of your profits because you refused to set a stop, or because you tightened it too much and got shaken out? Both mistakes come from the same root, impatience. The ATR stop cures that. It gives you a rational leash, wide enough to survive the market's breathing, but not so wide that you bleed. Every trader dreams of freedom. Freedom from the daily grind, freedom from worry, freedom to live by his own rules. But freedom in speculation only comes after chains. Chains of discipline, chains of method, chains of ironclad rules. Without those, the market will enslave you, whip you, and leave you broke. The ATR stop is one of those chains. At first, it feels restrictive, but later, you'll see it's the very thing that keeps you free. And Don't fool yourself, protecting profits isn't about greed. It's about survival. You'll find that the longer you play this game, the more you'll care about staying in the game, not about winning quick. Survival is the first victory. Growth is the second. The ATR stop serves both. Now let me tell you a story. I remember a trade in my younger days. I was long in a stock that was moving like a locomotive. Every day it went higher, and I felt invincible. But I had no rule for protecting profits. I just watched, and then one morning, without warning, it gapped down against me. By the time I acted, half my winnings were gone. That sting burned deeper than any outright loss, because it was avoidable. Had I tied my stop to volatility, I'd have been out before the collapse, with a handsome profit to boot. That's the day I vowed never to give back easy profits again. And haven't you felt that same sting before? The regret of knowing you had it, and then you lost it. That sting is what separates the amateurs from the professionals. The amateur tries to win it back by chasing. The professional builds a rule so it never happens again. That's the heart of what I'm telling you here. You don't fight the market with hope. You don't fight it with stubbornness. You fight it with rules. And the ATR stop-loss rule is one of the sharpest weapons you can put in your arsenal. Most traders learn the hard way that the market has a way of seeking out their stops, as if it knows exactly where they're hiding. You place your order just under the last swing low, thinking you're clever, and the next morning you find yourself out of the trade. Then, almost mockingly, the market turns around and marches in the very direction you had predicted. Haven't you felt that sting? That sense that someone is watching you, that the market is designed to humiliate your every move. It isn't personal, though it feels that way. What really happens is that most traders think alike, and they all place their stops in the same obvious places. The herd shows its hand, and the market, with its natural volatility, sweeps the board clean. That is the trap, and that is exactly why using the ATR stop-loss rule matters. It keeps you from parking your exit in the same place where every weak hand gathers. Think about it for a moment. If you can see a neat little swing low on a chart, don't you think every other pair of eyes on that ticker sees it too? The institutions, the funds, the old hands, they all know where the crowd places its stops. So, when the market dips just far enough to clean out those stops, it's not a conspiracy, it's just the market doing what it does. It breathes, it shakes, it rattles traders loose before continuing in its natural direction. That's not manipulation, it's volatility. And if you want to survive it, you need a method that accounts for that breathing. That's where ATR comes in. ATR, or average true range, doesn't care about your chart pattern. It doesn't care about swing highs or swing lows. It only cares about the actual range of price movement, the raw distance the market covers in a given time. When you build your stop around that, you're no longer guessing. You're no longer huddled with the herd in the obvious zones. Instead, you're tying your fate to the natural ebb and flow of the market itself. Doesn't that sound like the smarter way to play? Let's make it concrete. Suppose a stock typically moves $2 a day on average. If you place your stop just 50 cents under your entry, you're asking to get taken out. That stock breathes 4 times more than your tolerance. It doesn't even need to reverse to hit your stop. It only needs to breathe. That's the same as putting a bird in a cage too small. The creature will thrash and bump into the walls, not because it wants out, but because it's alive. The market is no different. If you don't give it room, you'll get knocked out of perfectly good trades over and over again. Now imagine you calculate the ATR and find it at $2. You decide your stop will sit at 2.5 times that value, maybe $5 from your entry. Suddenly, the stock has room to breathe. The normal shakes, the little dips and wiggles, won't bother you. The market can stretch its legs, and you can hold steady, knowing that only a real change of character, a move beyond the expected rhythm, will push you out. Doesn't that already feel like a calmer approach? The beauty of this method is that it doesn't just protect you from being hunted, it also teaches you patience. By setting your stop at a distance determined by volatility, you're forced to accept the natural noise of the market. You learn not to flinch at every tick against you. You stop staring at the screen, jumping at shadows, wondering if the trade is over. Your rule is clear: as long as the price hasn't violated the ATR stop you hold. You ride the trend. You wait. That discipline is worth more than any tip or system. Most amateurs won't understand this. They think tighter stops mean smaller losses, which is true on paper but false in practice. Because if your stop is too tight, you don't just take small losses, you take constant losses. Death by 1,000 cuts. You get stopped out 10 times in a row, each one small, but together they grind down your account and your spirit. You begin to doubt yourself, not because your direction was wrong, but because your protection was foolish. Haven't you seen traders who call the market right again and again, yet never profit because they're shaken out too soon? That's the danger of crowding your stop. ATR frees you from that trap. By widening your stop in proportion to volatility, you make each trade count. You may lose a bit more per trade, yes, but you give yourself the chance to actually participate in the move. And isn't that the point? You're not here to guess direction. You're here to capture profits. And you can't capture profits if you're out of the game before the move unfolds. Let me tell you a story. I once knew a fellow who prided himself on always using tight stops. He believed discipline meant never risking more than a sliver on any trade. Every morning, he'd line up his positions with stops just under the last pivot. And every week, the same pattern repeated: out-stopped on noise, only to watch the stock run away without him. After months of this, his account shrank, not from huge losses, but from constant little scrapes. He thought he was being cautious, but, in truth, he was feeding the market like a man tossing coins into a wishing well. Had he used ATR, had he given his trades room to breathe, his record would have looked entirely different. This is why I tell you, stop thinking of stops as mere protection against disaster. Think of them as instruments of survival against volatility. Volatility isn't the enemy, it's the nature of the market. You can't eliminate it, and you can't outsmart it. You can only adapt to it. ATR is adaptation in its purest form. It's listening to the market's heartbeat and setting your limits in rhythm with it. Ask yourself, what's more painful, taking a calculated loss when your ATR stop is hit, or watching a winning trade evaporate because you placed your stop where the crowd did? The first is controlled, expected, part of the plan. The second is torture, self-inflicted by impatience. One makes you stronger, the other wears you down. And in speculation, wear and tear on your mind is more dangerous than any single loss. The trader who can't trust his stops will never last, no matter how smart he is. So when you use ATR, you're not just placing a line on a chart. You're placing trust in a rule that shields you from your own worst instincts. You're saying, I'll step aside when the market proves me wrong, not when it merely wobbles. That difference is everything. It's the line between the crowd and the professional, between being shaken out and being paid out. Have you noticed that most of the best moves in your trading life came after long, messy periods of chop? The market fakes, it dips, it rattles, it does everything to scare you. But if your stop is wide enough set by volatility, not guesswork, you survive that storm and ride the wave when it finally breaks. That's what ATR gives you: staying power. And staying power is the closest thing to an edge a trader can have. Because here's the truth. No one can predict the future. No one knows if the next tick is up or down. But everyone can measure the past. And ATR is nothing but a measure of the past's rhythm. You can't tell where the market will go, but you can tell how far it usually goes in either direction before turning. And that, if used wisely, keeps you from being flushed out in the same obvious traps that swallow the masses. Now, doesn't it strike you as common sense that if most traders lose by being too predictable, your survival depends on not being predictable at all? ATR stops do exactly that. They pull you away from the crowd's obvious hiding places and give you a personalized, volatility-based line in the sand. You stop being the easy prey and start being the one who holds steady when others are forced out. That edge compounds over time, and before long, you'll see it in your account and in your confidence. Most traders come into the market thinking that their job is only to protect their original stake, that once they've got a cushion of profit, they can relax and play loose. That's one of the oldest mistakes in speculation. Protecting your principal is critical, yes, but protecting your profits is the difference between a man who speculates like a professional and one who gambles like a child. Profits are not house money. They are part of your capital the moment you earn them, and if you treat them lightly, you're just as reckless as if you were tossing away your starting stake. Haven't you ever looked back at your trades and seen a handsome profit turn into a break-even or even a loss simply because you didn't guard it? That's the sting of carelessness, and every trader has felt it at least once. The truth is, profits are harder to keep than they are to make. The market teases you with gains, then shakes them loose if you don't stand guard. And once you give back those winnings, you don't just lose money, you lose confidence. You lose the mental edge that makes you act decisively. Protecting profits isn't just about numbers on a ledger, it's about maintaining the discipline to believe in your own methods. That's why the ATR stop-loss rule is such a powerful ally. It enforces the discipline without asking for your constant judgment. It says, you've earned these profits, now let's defend them. Think about this: when you place a trade, you're risking your capital to gain profit. But once the market moves in your favor, you're in a new position. You're not only the defender of your initial stake, you're the guardian of your gains. Every tick in your favor is new territory conquered, and what general in his right mind would win ground in battle only to leave it undefended? That's what a trader does when he fails to protect profits. He leaves his gains out in the open, exposed to the counterattack of the market. The ATR stop is the fortress wall you build around that territory. Some men say, I'll just watch the market and decide when to take profits. That's a dangerous game. The market moves fast, faster than you can reason. By the time you think, by the time you weigh the evidence, the profit may already be gone. Discipline cannot be based on moods or impulses. It has to be mechanical. That's where the ATR stop comes in. It gives you a line in the sand, a place where your profits are guarded without hesitation or debate. Doesn't that sound like a saner way to trade than leaving it to your nerves? Let me tell you why guarding profits is more important than most men believe. When you lose a portion of your initial capital, you can shrug it off as the cost of doing business. But when you lose profits you already had in hand, the pain is sharper. It feels like a betrayal, as if the market reached into your pocket and stole what was yours. That pain leads men to make rash decisions. They revenge trade, they double up, they abandon discipline. The cycle of ruin begins not from the loss of principal, but from the careless surrender of profits. Protect them, and you protect your mind. Protect your mind, and you protect your future in this business. Now, how does ATR fit into this? Simple. Profits fluctuate just like prices do. They expand and contract with volatility. If you set a fixed dollar stop or a tight trailing stop, the market's natural noise will rob you of your profits before the real trend has ended. That's why you tie your defense to volatility itself. If the market usually swings 2 points a day, you set your profit protection at 2 or 3 times that. The move has to be extraordinary to knock you out. That means you're not exiting on noise, you're exiting on true reversal. Your profits are guarded not by guesswork, but by the very rhythm of the market. Doesn't it make sense to use the market's own heartbeat as your guide? Why trust your nerves when you can trust the numbers? Imagine you're in a trade that has already moved 10 points in your favor. You trail your ATR stop behind the price. As the market marches upward, so does your stop, climbing step by step, always giving the stock its natural breathing room. The beauty is that no matter what happens, you've locked in a chunk of that profit. You've already guaranteed survival. You can relax, knowing you won't give it all back. That peace of mind lets you think clearly, lets you hold on longer, lets you ride the real meat of the move. And isn't that what every trader wants? Not just to catch the move, but to hold it without panic. Most traders never develop this discipline. They either cut profits too quickly out of fear of losing them, or they hold too long out of greed, hoping for one more tick. Both errors are fatal. The man who cuts too soon never allows his winners to pay for his losers. The man who holds too long ends up handing back what he worked for. The ATR stop solves both problems. It keeps you in the trade long enough to capture the heart of the move, but it forces you out before you surrender everything. It balances fear and greed with cold, mechanical logic. Haven't you noticed that the market tests you most when you're ahead? A winning position makes you careless. You loosen your grip. You believe the market owes you more because it has already given you some. That's the trap. The market doesn't owe you a cent. If you don't lock in your gains with rules, the market will reclaim them without hesitation. The ATR stop keeps you humble. It reminds you that no profit is real until it's protected. There's another reason why protecting profits is so vital. Compounding only works if profits stay in your account. You can't build wealth by watching profits come and go. Every time you guard your gains, you strengthen your base for the next trade. You grow not just by adding new wins, but by preventing the erosion of old ones. Over time, that makes the difference between the man who merely trades and the man who builds wealth. Picture two traders. Both pick the same winning trades. One guards his profits with ATR stops. The other does not. After a year, who do you think has the larger account? The one who protected his gains, of course. The trades may have been identical, but the results are worlds apart. That's the compounding effect of discipline. Protecting profits is not about being timid, it's about being consistent. Some traders like to tell themselves, it's only profit. I can afford to let it ride. That's the talk of a gambler. A professional treats profits as capital the moment they appear. They are not chips from the casino. They are dollars in the bank. If you dismiss them as play money, the market will gladly take them back. Haven't you seen a man ride a winning trade all the way up, only to give it back and end where he started? That man worked for nothing, all because he didn't respect his profits as much as his original stake. The mindset you build when you protect profits is the same mindset that keeps you alive in speculation. You learn to respect every gain, no matter how small, as part of your ammunition. You stop seeing trades as isolated events and start seeing them as parts of a campaign. Each profit adds to your war chest. Each stop protects your ground. That's how campaigns are won, not with reckless charges, but with careful defense of every inch of territory. And that's why the ATR stop is not just a tool, it's a philosophy. It says, I will not let ordinary market noise rob me of what I have earned. I will guard my profits with the same care as my principal. I will trade like a professional, not like a gambler. That philosophy, lived day after day, transforms a trader's results. It builds steadiness, patience, confidence. It teaches you that true wealth in speculation is built not only by taking good trades, but by keeping what those trades give you. Most men think the hardest part of trading is finding the right stock to buy or the perfect moment to sell short. They think if only they could read the tape well enough, or study the chart carefully enough, the rest would take care of itself. But the truth is, the hardest part of trading comes after you are right. The hardest part is protecting the profit that you already pulled out of the market's hands. $1 is not secure until you lock it away with discipline, and yet too many treat profits like loose change in their pocket. They let them jingle around, and the market, like a pickpocket, snatches them back without resistance. Haven't you ever lived through that pain, watching a trade show you a fine profit, only to end the week flat or worse? That lesson cuts deeper than any ordinary loss because it shows you your own carelessness. Profits are not gifts and they are not favors. They are earned through risk, patience, and the courage to enter when others hesitate. Once they are in your hands, they must be treated as capital. A trader who guards his principal but neglects his profits is like a man who builds a house but leaves the doors unlocked. The thieves will come in, and before he knows it, the place will be bare. That is why I say protecting profits is the second half of trading, and it is just as vital as protecting the stake you begin with. The market is a battlefield, and every profit is ground you've taken from the enemy. Would a general win a hill and then leave it undefended? Of course not. He would fortify, dig in, and make sure no counterattack could push him back down. In speculation, the ATR stop is that fortification. It tells you how much room the market normally takes when it swings. It lets you build your defense not on wishful thinking, not on where everyone else places their stop, but on the true rhythm of the market itself. Consider the trader who sees a stock climb 3 points in his favor. He feels good. He feels strong. But he has no plan to defend that gain. He says, "I'll watch it. I'll decide when it feels right to sell." Then the market dips a point and he grows uneasy. Another dip and he panics. By the time he acts, the profit is gone. This is the fate of the man who guards his profits with nothing more than nerves. Emotions are no defense in speculation. They betray you in the very moment you need clarity. The ATR stop is different. It's mechanical. It doesn't ask for your mood. It doesn't care about your fear or your greed. It moves with the market, giving it room to breathe, but never letting the price come all the way back to rob you. When you trail an ATR stop behind your position, you do more than protect numbers on a ledger, you protect your mind. You eliminate the torment of should I sell now, or should I hold a little longer? The rule answers for you. You stay as long as the market remains healthy, and you exit when volatility proves the move is over. You do not hand back a profit because you were indecisive. That peace of mind is what allows you to ride the big swings, the kind that make the difference in your year. Haven't you noticed that the greatest moves always demand patience, and patience is impossible without rules to support it? Many traders will argue that protecting profits too tightly kills the trade too soon. They say you have to let the winners run. That is true. But letting a winner run does not mean leaving it naked. It means guarding it with a stop that breathes with volatility, a stop that moves up as the market moves in your favor. The ATR rule does exactly that. It adapts. If the stock is calm, the stop is closer. If the stock is wild, the stop is further. In every case, it is tuned to the heartbeat of the market. This way you are not smothering the trade, but you are not gambling with your winnings either. It is amazing how many traders confuse recklessness with courage. They think refusing to take profits is bold, when in fact it is foolish. Boldness in trading is not in refusing to sell. Boldness is in sticking to your rules when greed tempts you to break them.